Welcome to the MTA Podcast Series, a weekly audio cast featuring interviews with recognized industry professionals. And your host, Ed Carlson.
November 24th, 2009. Are you ready for another lost decade? Our forecast calls for an extended trading range with a downward bias, but we cannot rule out the possibility that in terms of absolute prices, the secular low may have already been seen. Today's guest from the Pring Turner Capital Group in Walnut Creek, California is Martin Pring. Martin marketed in 1969 and founded Pring Research in 1981. He is the author of several books, including the classic Technical Analysis Explained, which is now in its fourth edition and has been translated into over 8 languages. Described by Barron's as a technician's technician, Martin's articles have been featured in Barron's, and he has been quoted in the Wall Street Journal, Financial Times, International Herald Tribune, the New York Post, and the Los Angeles Times. In 1997, Worth magazine selected his Investment Psychology Explained as one of the 15 best investment books in the last 150 years. Martin Pring, welcome to the program.
Thank you very much, Ed. I'm delighted to be here.
Wonderful. Say, before we get started, that's quite an accent you have there. Can you tell us where you're from and what brought you here?
Well, I was originally born in Bristol, England. I spent 12 years in Canada as a broker and moved to the States in 1978, and I've gradually been moving southward from upstate New York, where I am now, which is Florida.
You're in Florida now?
Yes.
Oh, well, so much for Walnut Creek, California. Where did I get that?
Well, that's our money management arm, Pring Turner Capital Group, and they're based in Walnut Creek, California.
I see. What brought you to Canada originally?
Basically, I didn't like the socialist government that was going of Harold Wilson in the UK in the 1960s.
Oh.
And decided I would emigrate to the colonies.
Right. And how long were you a broker there?
I was there in Canada for 12 years and had a wonderful time.
What part of Canada was that?
I lived in Toronto for 4 years and in Montreal for 4 years.
Oh, okay. And then you made another jump, and as you said, you've been looking for warmer climates ever since. So somewhere in all that traveling, you obviously found time to discover and to develop an interest in technical analysis. Do you remember quite just how that happened and how you made the jump from sales as a broker to analysis?
Well, I first learned about technical analysis when I was in a training course for a company called A.E. Ames, which was the second largest underwriter in Canada at the time. And they had a terrific library, and in the library they had this book called Edwards and McGee on stock trends. And I found it to be a fascinating book. And from there I learned more and more about technical analysis. Eventually I got made to be a manager up in a little town called Owen Sound, about 100 miles north of Toronto. And I found that our Ames research was really terrible, so I used my technical analysis to help my clients.
Uh-huh. And then how did you happen to make the transition from broker to analyst, or was there something in between there?
Well, there was. One of my clients used to subscribe to a publication called the Bank Credit Analyst. And the bank credit analyst at the time was telling us all about inflation and liquidity and interest rates and so forth, and I thought it was an extremely fabulous publication. But I could see from what little I knew about technical analysis that they didn't know much about it either. So I went back and researched in our Ames library of the previous copies and showed them where I could have perhaps helped them and suggested I consult for them, which I did. From my perch in Owen Sound, and then 2 months later I get transferred to institutional sales in Montreal.
Huh.
And there I was forced to sell that bad research that I didn't like. So there was an easy step to join the bank credit analyst, do some research on monetary stuff and technical stuff, and then from there I began to write books and things.
Uh-huh.
So it was a very, very lucky experience.
Uh-huh. Well, as part of that experience, I know many people have no doubt influenced you. Two who have, I was hoping maybe you could give us a little background on. In your 1993 book, Investment Psychology Explained, on page 1 of chapter 1, you quote a man by the name of Garfield Drew Now, this month, 16 years later, you published your paper, Are You Ready for Another Lost Decade, in which you mention him again. Who was Garfield Drew?
Well, Garfield Drew was a noted technician in the 1940s, and he's most famous for his work on odd lot sales. The idea that the little guy is wrong at major turning points. And he also understood a lot about the psychology of markets and things. And I always used to quote about the fact that stocks don't sell for what they're worth, for what people say they or think they're worth. Because the more I study technical analysis, the more I realize psychology is the all-important factor that we need to understand.
Mm-hmm. Mm-hmm. Another name. In your book, Technical Analysis Explained, you footnote that your KST, or No Sure Thing indicator, was adapted from a technique used by Ian Notley. Quote, in my view, the world's leading analyst of financial cyclic phenomena, end quote. Who was Ian Notley, and what did he do, and how did that become the KST indicator?
Well, during my sojourn in Montreal, I was lucky enough to go to a lecture given by Ian, and it was a lecture on the interaction, really, of the primary trend, the intermediate trend, and the short-term trend, using his momentum indicators. And his momentum indicators were based on a weighted approach, where you would take 4 different rates of change and weight them by different weights, and they come out with a very nice smoothing for the short-term, the intermediate, and the long-term trend, and that gave me the idea to develop the KST. And Ian was sadly passed away last year. Was a very good friend, and did some tremendous work on cycle analysis, not just those 3 trends, but secular trends. And he was a really broad thinker, a really brilliant guy. Mm-hmm.
Did he publish any books?
Not to my knowledge, no. He did his Notley Notes, which he sent around to institutional subscribers once a month. But I'm not aware of any book that he may have written.
Well, is there any way that the rest of us can access his writings?
I don't know of any way you can at this point.
Okay. Well, if you think of it, you might keep us apprised of that.
Yeah.
We're going to continue with our special guest, Martin Pring, in a moment, but first a reminder that on next week's program, we'll have as our guest Elliott Wave and socioeconomics expert Robert Prechter. You won't want to miss it. Let's talk about the current market environment, Martin. You mentioned in a recent report that the primary bullish trend may be on track for a 6 to 12-month extension. A lot of folks are looking at the overhead resistance in the S&P right where we're at today. I know that Mr. Prechter put out a report just yesterday saying that was it. We're going down from here. What are you looking at that would make you think that perhaps we could see more in this bull run?
Well, first of all, we're only about 9 months into this bull market. And when I look at a lot of my long-term momentum indicators, they're only just starting to turn up from way below zero, and traditionally they've gone at least to the zero level before they've reversed and turned down. Also, in order for me to get bearish, I've got to see some kind of a trend reversal signal, and that would be crossover, negative crossover of something like a 9 or 12-month moving average. It's certainly not a perfect approach, but at least it gives you some objective discipline. As to whether it will last for another 6 to 9 months, I'm just looking at previous averages and so forth. Mm-hmm. I think the really important thing is, and I wouldn't disagree with Bob on the fact that we are at resistance and we're probably going to have some kind of intermediate correction here. But the really big point, I think, is that we are in a secular bear market, and I believe we're only halfway through this secular bear market.
Well, that's a real good segue to what I was thinking would be the primary focus of this call. In your paper, Are You Ready for Another Lost Decade? You took the reader through several fascinating points. I mean, and when I say fascinating, points or proofs that we're still in a secular bear with a long ways to go. I always think it's fascinating when a technician can use evidence that someone who does not have a background in technical analysis might feel comfortable with, the person who's used to the fundamental side of things. You mentioned a number of things: Shiller PE ratio, the number of recessions we typically see in a secular bear, dividend yields, even Tobin's Q ratio. Perhaps we could spend some time and you could just take us through each of these points and explain to us your viewpoint on this secular bear we are in now.
Well, first of all, when I talk about a secular bear or a secular bull, I'm really talking about not absolute prices, but prices adjusted for the CPI. Because when it comes down to, I can make 20% in the market, but if inflation takes 30% of that away, takes all that away and some more, then obviously I'm not further ahead. So what I've got to think about, first of all, is what is the real purchasing power of the S&P or whatever we're talking about. So that's how I'm measuring these secular trends. The interesting thing about price-earnings ratios is that people mostly use them as measures of valuation. I use them as a measure of sentiment, because why is somebody willing to pay $40 one point and then only $8 or 8 times price earnings another point? It's really a psychological thing. And if we look at Shiller's price-earnings ratio, which he gives us a really good history all the way back to 1881, I think it is, you see a number of different secular bull and bear markets. The secular bear markets were 1900 to 1921. When you adjust it for inflation, it was really 1929 to 1949, although the actual low was in 1932. And the third one was between 1966 and 1982. Well, we reached another peak, and these are all associated with peaks in the Shiller price-earnings ratio, where the ratio moved from an extreme of around 30 or 40, about 20 to 25, down to about 8 at the secular low. Well, in the last cycle in 2000, we got up to 40, I think it was 44, certainly in excess of 40. And currently we're around 18. And typically secular bear markets have ended when these price-earnings ratios have been around 7 or 8. So we obviously have a long way to go if we're going to reach those levels again. Similarly with dividends usually peak, dividends usually around 3% at market peaks. Last time they were about 1%, which is an extraordinarily high level of valuation. And the secular bears don't usually end until dividends get about 6 or 7%. So we see these huge swings in these measures of valuation, or as I put it, measures of psychology. And we're nowhere near that level at this point.
And you also had a couple other items on that list. I thought it was interesting, maybe just because it's so simple, the number of recessions we normally see in a secular bear market.
Yeah, they've averaged between 4 and 6, and we've only seen 2 recessions so far in this current bear market. And the secular bear markets typically last, I think the average of the other 3 was something like 18.5 years or something, and obviously we've only been going since 2000. It's now 2009. So I put us as probably halfway through this secular bear.
Mm-hmm. Mm-hmm. And then finally, the replacement value of assets, or Tobin's Q ratio. Perhaps you can bring us up to speed on that.
Well, that's just a measure of the replacement cost of the market. And typically when we get to one of these secular lows, stocks are a real bargain in terms of their replacement value. And I think the number is around 0.3 or something, replacement value, or 0.4. And the last, I think I forget the exact number. You've probably seen it in the report. I think it was about 0.60 or 0.70 or something. So again, there's a long way to go until we get down to those good valuation levels.
Mm-hmm.
The whole thing is, it's a psychological thing, and we have to unwind the incredible optimism and go down to incredible pessimism when no one wants to own stocks. And this takes several different cycles, backing and filling and coming down until people are totally disgusted with equities, and then we're in a position to move up again.
Mm-hmm. I'd like to talk to you about the bond market. The commentary we hear from analysts out there, be they technical or fundamental analysts, economists, it's almost schizophrenic. There's a certain group that's concerned about inflation, which of course we would not expect that to be healthy for a bond market. On the other hand, there are the deflationists that are obviously concerned about deflation, but that would be a pro-bond market stance. And then you get into the technicians, which the majority, anyway, of what I've read seem to agree with the deflationary camp that, excuse me, I take that back. let me quote something you had written. A quick business cycle analysis suggests risk of capital loss for bonds is very high. Okay, it seems like so many technicians I'm acquainted with are concerned that this 20-year bull market in bonds is over. But you like to mix technicals with fundamentals, or at least it would seem from that last paper in our preceding discussion. Talk to us about the bond market. Obviously, even I'm confused. Give us your thoughts.
Well, first of all, in a cyclical sense, I've got an indicator, I call it the growth indicator, which I put in my publication each month. And this is basically a momentum indicator of several indicators that are very sensitive to interest rates. And when they reach the kind of level that they reached last month, and in fact are even higher this month, typically that has either been low in short-term interest rates or short-term interest rates have already been moving up. And that suggests to me that the Fed really should be raising rates now. I know they're having a difficult time because everyone's concerned about the unemployment numbers. But because the business cycle is a sequential thing, we don't really, as analysts, we shouldn't be worried about unemployment at this point. We should be thinking about the inflation that's going to happen if the Fed temporizes on interest rates. So in a cyclical sense, I think we're ready for a rise in interest rates. In a secular sense, we saw a very, very strong signal about 9 months ago. And this signal is what I call an extreme swing. And an extreme swing happens when you take something like a 13-week rate of change or something of that nature, and it reaches a multi-year overbought level, which is what bonds did last January. And then from there, you see a multi-year oversold. Well, this was not only a multi-year overbought and oversold, we saw that swing. It was a multi-decade. In fact, it was a record. I'd never seen anything like it before. The only thing that compares was the reverse type of situation in 1932, when you went from a record oversold to a record overbought. So that, to me, indicates a dramatic change in psychology which has taken place in the bond market. It's not yet evident. I don't yet have the trend confirmation signals, and there I need to see long-term interest rates move above, the 20-year yield move above 5%. When that happens, I've got the confirmation of trend on this momentum characteristic.
Okay, well, we'll be watching for that. Last question. When it comes to the markets in general, equities, bonds, fixed income, commodities, what keeps Martin Pring up at night? What is it that in the back of your mind you're watching and waiting for, and just have a funny idea that this could happen, but you're not ready to publish on it yet, but you're watching for it and wondering?
Well, actually, I do publish on these things before they've happened, because one of the things I like to do with my subscribers is warn them of chart points that, if they're triggered, will probably give a significant reversal in trend. One of those, in terms of inflation signals I was looking at, was one, gold going over 1,000, which has obviously happened. And the other inflationary signal, secular inflationary signal, would be this move of 20-year bond yields above 5%. If we see that confirmation too, that tells us that the bond market's seeing inflation down the road as well.
Martin, it's been wonderful having you with us today. Is there anything else you'd like to mention before we go?
No, I'd just like to say, Ed, I really enjoy your podcasts. I record them every month and every week, download them, and I listen to them on the way to the gym and on the way back. I think you're doing a great job. Thank you. Well,
thank you. That's very kind of you. All your check's in the mail. Well, that wraps up today's MTA podcast. I'm Ed Carlson in Seattle. You can follow me at fatechnicaladvisor.blogspot.com or contact me at fatechnicaladvisor@comcast.net. Send us your comments and suggestions. Let's keep our stops tight. Good day.